Today, housing policies in the balance. Hello again, it's Martin North from Digital Finance Analytics, well, notice post covering finance and property news with a distinctively Australian flavour. Well, the election is on, and the major parties are all talking about various housing policies, and I wanted to explore that with Steve from Canstar. Hi, Steve.
G'day, Martin.
Very interesting conversation, this, because, of course, there is a little bit of noise now about housing. Well, I said a couple of weeks ago, no one is talking about housing. Well, they sort of are. But they sort of aren't. I mean, if you look at the policies actually in the round, they're a little bit marginal at best, I would say.
Yeah, they are. They kind of don't resolve the problem. They kind of address the symptom, not the problem. So it's sort of like we're giving you a Band-Aid or an aspirin to fix the housing problem. We've known that there's a major issue in Australia over housing affordability. Lower income people can't get into properties. First home buyers are struggling to put together the deposit. So we know there's a major issue with housing in Australia. And unfortunately, it hasn't been addressed by these, but we can still talk about what the parties have on offer to at least help out and put that Band-Aid on the problem for individuals.
Yeah, and it's worth saying, just to start the conversation, there is supply side issues and demand side issues, right? So a lot of the issues are about supply side, trying to get more stuff built and trying to get people brought forward to go buy. But some of the demand side, which is effectively, well, how much do you need to borrow and how big is the mortgage? Nobody really wants to go there. And why are house prices so high relative to incomes? Why is the 6 times debt to income ratios now, almost a minimum in many centres? Those are the hard questions that nobody wants to talk about. And in fact, there was a recent inquiry in Canberra looking at the supply side issues, and they were able to say, it's the state's problem, right, rather than actually a federal problem. So we should recognise this is not really tackling the fundamental structural issues around housing. It's more fiddling at the edge, but it's also trying to make a good political spin so that you can say, well, we're doing something on housing, right? And also it will marginally help possibly a few people to get in who can't get in, but it's not really addressing structurally the fundamental issues.
No, it's not. And you talked about supply side issues, and just to talk about that for a minute before we get into the real meaty bit on demand side, supply side issues. The problem with the sort of measure that's come in here and the home builder measures that came out during COVID are that they did pump a lot of money into the housing sector, and it did cause a massive takeoff. I mean, first home buyers absolutely ballooned during the early days of COVID, and effectively what it's caused is a shortage of supply of building materials and tradies and builders, and it's bumped up the costs of building. And yes, those measures did get people into houses, first home buyers into houses, but at a high cost, and it transferred a lot of money into the building industry. That's who were ended up being the big winners out of it. And frankly, in terms of COVID, they're not the ones that suffered as much as many other sectors. So it's actually aggravated the supply side issues.
Absolutely, you could almost say that some of those policies were, builder keeper.
Yeah, well, they were actually. That was I think that was really the point of them, as much as anything else, because they could have, the government could have supported first home buyers much more directly, rather than with that style of, because the biggest incentives were available for building or for newly built houses. So it was all about keeping people in jobs and keeping tradies in jobs, keeping the whole building sector in jobs, because it is such a big employer. So it was all about that more than actually assisting first home buyers get into properties. But it did have that side effect where it was a great opportunity for people to get in on very low deposit and find a way of paying more for a property, but at least having one.
Absolutely. So, people need to understand there are multiple motivations when politicians start throwing money at the housing sector, right?
Yeah.
And a lot of them are aligned to the construction. Anyway, let's just talk briefly about the current rack of policies that are being spruiked through this election campaign.
Yeah. Okay. Well, the coalition made announcements during the budget. So the budget was only a month ago. So it's very fresh. They increased the number. Well, they renamed the program to the first home. It was the first home loan deposit scheme. They renamed it the first home guarantee scheme, and they increased the number of places that they were offering. So, but they've got four different schemes. They've got a first home guarantee scheme, a family home guarantee scheme, a regional home guarantee scheme, and a first home super saver scheme. We can talk about that, but that's a different thing altogether. But there are 35,000 places in the first, 5,000 in the second, 10,000 in the third. So they increased the number of places from 50,000 to 10,000, from 10,000 to 50,000. So they've had this program for a while. Now, what this program does is that you can get into a house with a 5% deposit without having to pay for lender's mortgage insurance. And lender's mortgage insurance can be a very expensive item. It adds to the amount that you have to borrow, because you need to borrow more to cover this expensive premium, which can be 10, 15, 20,000 if you're borrowing enough. So it's an expensive one-off upfront premium that it's saving. So effectively, you're getting in on a lower deposit, getting in earlier into the market. You have a bigger loan because you don't have 20% deposit, but you're getting in without having to pay the lender's mortgage insurance. So that's the plus.
So very interesting point that you've just made, Steve, there is that, yes, you can get in with a smaller deposit. And of course, for many people, saving up that deposit is the problem because their cash flow is quite tight, but also any money they put into a savings scheme hardly earns any interest. So you don't get any benefit from that. So trying to save a 20% deposit is really tough, right? But if you can get in with a 5% deposit, you can get in sooner. But you've got a bigger loan to start with because you're borrowing 95% of the value of the property, right? The bank isn't, the bank or the government isn't paying the difference in the interest. You've got to pay the difference in the interest. A lot of people haven't woken up to that until it's a bit late.
And the repayments are a lot higher. Your loan is a much bigger loan. That's the simple truth of it. And you've got to repay it. It's interesting because, we all know that the real pain point over the last couple of years for first-home buyers has been the deposit. That's the bigger pain point because interest rates have been so low that once they're into the loan, they've generally been able to repay it. But now we're in a situation where interest rates are going up and the repayment, the affordability of the repayment is going to be the limiting factor pretty soon. So that's why it's going to get tougher if you've taken advantage of that 5% entry and haven't actually saved a little bit more. So when interest rates start going up, I think that's going to really be a massive pain point for people.
Yeah, and so the other point there, Steve, is that if prices start coming off and we start seeing values declining, then effectively that 5% disappears first. Right, and then suddenly, the government presumably has responsibility for the next bit, but in negative equity, you still have ultimately the problem of the negative equity. It's not the government, it's not the bank. Yeah. They're just allowing you to continue to sort of go through that process. So again, it's very important to understand what this does and what it doesn't do in terms of the benefits to the purchaser.
Yeah, exactly. Look, what I meant to mention earlier and got lost on is that. What effectively is happening is that the government isn't putting money into this. The government is saying to the bank, we guarantee that first 15% loss if there is a loss on the property and it has to be sold. So that's all it's doing. It's the government guaranteeing the bank, not you, the borrower. You're still carrying the can for the whole loan, and that loan might be up to 95% of the property value. But it does help you get in. It saves you the LMI, the lender's mortgage insurance, and at the end of the day, provided you can afford the repayments, it will all work out fine. But the repayments are going to be tougher because as increases go through, it's on a much bigger loan. So that's what people have to factor in and realise that that they are going to be up for. They're putting more pressure on themselves going forward in doing this. Now, with interest rates going up, property prices are likely to stabilise and probably go backward in plenty of places, which takes a lot of the pressure off first home buyers. This fear of missing out isn't going to be as intense as it has been over the last couple of years as property prices have gone up. So people will be in a position where an alternative to any of these schemes is that maybe save for a bit longer, and saving for a bit longer isn't as, I guess, precarious as when property prices were going up by over 20% in 2021.
Well, for a lot of people, they felt the train was leaving the station. They were running on behind, trying to get on the back. Right now, maybe the train the train is sort of sitting in the station, and it may come towards you. So it's I think it will. I think it sort of looked like it left the station because it's shown that first home buyers volumes are down 25% over the last 12 months. Absolutely.
So to a lot of people, it looked like the train had left the station, and it probably might have, but it looks like it's now just backing up and taking on some more passengers. So, exactly. which is one of the good news stories, frankly. Those who didn't jump in and felt they had lost out are now really being given another bite of the cherry. So I think that's one of the good news pieces here. Plenty of them will be quite thankful that they didn't jump in the second half of 2021 and pay those high prices. Future's always there to be seen, but I think there'll be some reversal in prices at least, and I think it does give people another opportunity to get in. So that's the good news.
Yeah, absolutely, it is good news. And I'll also make just one other point though. We have full recourse loans in Australia. Right, and that's really important for people to understand, right? So it's not like in some states in the US where if you hand the keys back, it's not your problem anymore, right?
Yeah.
Even if you've got this government support, or even if you've got other mechanisms, when you come to sale, if ultimately the equity in your property is insufficient to cover the full value of the loan outstanding, the buck still stops with you as a borrower.
Yeah, it does. That system in the US, it's not in every state, of course, and which is what you said. But that system in the US, I guess as an old banker, I look and just shake my head. I just can't believe it. But yeah, and during various periods in time, drop the keys on the desk of the banker and walk out with a big fat grin on your face was very common, and that's how they ended up with those whole suburbs that became ghost towns in the US during the GFC. And it was all care, no responsibility when it came to borrowing for the individual. So I'm glad we don't have that. But it's absolutely right. I mean, if the damage is all your damage, the bank tends to get out of it okay because they, if you've got go in with low equity, lenders mortgage insurance or government guarantee with this with the existing scheme, and they tend to get out of it okay with housing, and that's why banks love lending to people on home loans, but the individual doesn't, and it takes a long time to recover if you get into this sort of trouble.
Absolutely. So, be careful, be cautious, and, ask all the hard questions, read the small print. Now, let's talk about the other side then, because they've got a bit of a different strategy. Yeah,
they have. And there's good and bad in this one too. The same trap can exist. You end up with, getting in early, but the risks in a lot of ways are mitigated here because they're addressing both the affordability side of the equation and the deposit side of the equation. So the existing schemes are all about 5% deposit, but you take on the full loan. This scheme is what's called a shared equity scheme that Labor's proposing, and in this case, what they do is that they're prepared to take on the equity, so be a partial owner of the property effectively. Up to 40% for new houses and 30% for existing houses. So you'll buy a property for $1 million, you'll put $700,000 into it. Now that's the loan plus your deposit, and the government will put in 30%, 300,000. So they're sharing the property with you. They're a joint owner of the property, and you can get in as you can end up buying for this scheme. The deposit's only 2% on this. You can end up buying a property for $800,000 with just $16,000 worth of deposit, plus your stamp duty and fees and stuff. But just $16,000. Now, and it's addressing the two issues now. The existing scheme addresses just getting a deposit together. This one addresses both getting a deposit together and the affordability of the repayments, because the loan's a lot smaller. So there's less risk. And this one's actually available to first home buyers and to other lower income earners. So it's a different style of scheme. What you've got to be aware of course, is that you don't have all of the upside of the property. So if property takes off in a bonanza growth again, well, you're only going to get 7/10 of that, or 6/10 of that, depending on which scheme. So longer term, your wealth won't escalate as much, but you'll get into a house, and that's the important thing. So it's a scheme that I think addresses it more broadly and puts people under less immediate risk, and obviously potentially will cost the taxpayer more money, but maybe not if the government's guessed right on the direction of property longer term. Probably not. Now, there are a whole lot of provisos in how it works, and a whole lot of flexibility you'll lose about the property, but if you desperately want to get in, it's available. Now, it's only available to 10,000 people. That's the other issue. It's not something that's going to make a huge difference, because 10,000 people every month, 10,000 first home buyers every month, even on today's lower volumes, are first home buyers.
Absolutely, yes, and that 10,000 from Labor is over a term. It's not just per month, right? So it's much more.
Yeah, that's right. That's a year.
Yeah,
it's 10,000 a year. Yeah.
And it's interesting because shared equity schemes have been around. There are already some in Western Australia that have worked reasonably well, and in the UK they've also used similar things. Works in a rising market. It's not very effective in a falling market, because essentially everybody's losing value, right? And that's the problem. Yes. And that means that the government potentially loses as well as the individual. And the other caveat, or the other point to understand, is that you have the option later to buy more of the equity from the government.
Yeah, well, you actually had the option, and in some cases the obligation.
Correct.
If you're the cap on income is $90,000 for a single person, $120,000 for a couple. Now, if your income goes up, now I don't know by how much at this stage, and I'm not sure it's been figured out yet, but if your income goes up, you'll have an obligation to take on more of the equity. And so, in other words, you can now afford a bigger repayment, you can afford a bigger loan. You might end up taking another 5% or something of the equity if you go up by, your income goes up by $20,000. I don't know. I haven't even thought about the magnitude of it. But that'll be an obligation, but you'll also have the right to take on further equity. Now, I don't know at what price that will be, whether it will be at some estimate of market value. I think it would be, because the scheme only really works for government if it sort of self-funds. Otherwise, it could be it won't be a bottomless pit, because there's only 10,000 places, but it could be a big pit anyway of spending, because if prices do fall, that's a problem. If they allow people to get out at the original price, well, that's not viable, so it'll have to be at some sort of market price.
Yeah, absolutely. And it's worth saying, I guess, that there are a few other parties with other flavours of policy, from policies of trying to cap mortgage rates, or building vast numbers of houses, or, completely restructuring. But I guess the point is, amongst the two major parties, the flavour is a little different between the two. But as we said at the start, these are really, really marginal policies. This is not going to fundamentally change the housing market. It's not going to deal with the massive issues with lack of rental property at a reasonable price. They are really just playing at the edges.
Yeah, they are, and just to highlight the difference between the two, the existing coalition policy and the new ones that were brought out during the budget just address the deposit gap, leave you with a very big mortgage with interest rates going up. There's quite high risk on the individual. The Labor scheme proposal addresses those risk issues and deals with the affordability of repayments and with the deposit problem, but is only available to 10,000 people. So that's 1 month's worth of first-home buyers. So make your judgment on that. But to that more fundamental issue of the market, well, the issue with the market is runaway house prices. And that's why people are having trouble putting together deposits, and loans will be too big to be affordable. And that hasn't been looked at all in either manifesto. And I think, you know, we need to address this. It's a longer term problem. It's a cross-generational problem, but also a demographic and income demographic problem where lower income earners are really being excluded from the housing market. So we need to address that. We need to find a way of slowing those house prices, and you need to address, I believe, the supply side issues and make it easier to get more property onto the market and at lower cost. But also the demand side that you've alluded to, Martin, and I think when you look at first home buyers, they are in direct competition with investors.
Yep.
And you know, people who are upgrading are buying a house and selling the house. So it's a zero-sum game. They're not taking a property off the market that a first home buyer could be buying into. But if you're an investor, you are. And so the two groups are in direct competition. I can't find any way of dealing with this other than negative gearing, clamping down on negative gearing and reversing it, not backdating it, but stopping that. But also, I think you've got to look at the capital gains tax. And, you know, at the stage in life I'm at, I shouldn't be arguing this, but I am anyway. I think the discount for capital gains tax just doesn't make sense, frankly. We're charging people higher tax rates by 100%, double, on the fruits of their labour, their salary, their wages, than a capital gain that's happened in the share market or in the property market, that no sweat of the brow has been gone into that. And it's just, I don't understand it. It's just not fair. So I think we've got to address those two things to really try to slow up the investor impact on the market.
Yeah, absolutely. Well, the structural reform agenda, which is what you're talking about there.
Yeah.
When of course Labor did try some of that last time around and failed miserably, which tells you something. And I suppose the point there is, turkeys don't want to vote for Christmas, right? Just as homeowners don't want to vote for house price falls. But the bottom line is, without actually addressing those fundamental structural issues, like that property prices are way too high relative to income, relative to GDP, we've been too free on the lending side, and as you say, the investment thing is part of the problem too. But nobody really wants to have a conversation about those really difficult, complex things, because everybody's got an interest in the short term rather than the long term, and nobody wants to vote prices down.
Look, it's hard to blame politicians for not wanting to talk about it, because we saw what happened at the last election, and it probably did swing the election. So I understand they wouldn't want to talk about it. If you cast your mind way back to the Houston opposition and their openness about bringing in a new tax, and remember the cake, and then go fast forward a little bit to the Howard government. Well, the Howard government just pulled the thing in and minimum fuss and just did it, and probably there's been no looking back. It's been a good outcome. But bringing in new taxes or taking away taxes or bumping up taxes is not a policy that wins votes at the ballot box in a couple of weeks' time. And so I can understand why they don't want to talk about it. I'm hoping that there'll be proper debate about it in whichever flavour of government we get, and that it is addressed. Because I think you talk about house owners, don't want to see it all slow up. Well, I don't know. A lot of house owners have kids too, and I want to see my kids get into houses for themselves. I want to see them live in a society that has kind of equity and fairness and gives everyone a fair go.
Absolutely agree with you. Yes, this is a really important structural issue, and we'll be continuing to talk about it, and hopefully after the election we might get a bit of a movement. Steve, I really appreciate your time today. Very insightful. Thank you for that, and I'm sure we'll catch up again soon.
I think we will, man. I hope so. Yeah.
Thanks. Okay, take care.
Cheers.
Bye-bye.
Okay,
bye.
bye.